right, I know we have a few more joining us, but we will go ahead and get started. We have an exciting session for you all this morning. We're joined by Steven Vogt, CPA, as our guest speaker, and then, as always, Paula Whittakin joining us from SBDC as well to provide an update at the end of the session. So I want to begin by introducing our speaker, Steven Vogt. Steven Vogt is originally from Lansing, Michigan, and now spends his summers in Grand Haven, Michigan. He moved to Arizona back in 1981, has been married for 33 years with 4 wonderful children and 5 grandchildren. Steve has his degree in accounting, which he got from Arizona State University. He's now a certified public accountant and an enrolled agent, has securities license and has helped clients invest. He's the owner of Steven M. Vogt CPA and has 2 offices in Chandler and Queen Creek, where he's able to serve 2,500 clients. And I'm sure it has been a busy year for you this year with all the adjustments with taxes and all of the different funding programs. So Steve, we're excited to hear from you today on some tips on year-end reporting and how to avoid being audited and all of the changes that everyone is anticipating. So I'm going to go ahead and pull up your slides here so we can get started.
Thank you, Carly. Good morning, everyone. Can you hear me? If you can hear me, thumbs up. You can hear me? All right. I like starting every presentation by asking, because a couple of months ago I did a 10-minute presentation, and then I was told at the end that it was a great presentation, except for the fact that I was muted the whole time. And they were just kidding, fortunately. What we're going to talk about today, next slide, is a few topics which I think are going to be relevant to just about everyone who's in this webinar. Going to talk about some ways to save on your taxes at the end of the year, individuals as well as small business owners. Talk about 6 reasons why businesses get audited and give you some ideas on how you can avoid that. And also we're going to talk about tax proposals under the Biden administration. And no, we're not going to talk politics, but you do need to be aware of some tax changes that are likely to come. It might make sense for you to make some decisions that could help lower your taxes if you take actions over the next 2 weeks. Also, I'm going to talk just a little bit about Paycheck Protection Program. Also, I want to let you all know that if you see any errors, spelling, grammatical, math, I want you to know they were intentional, just to make sure you're paying attention. Next screen. And we can skip that since Carly did a great job introducing me. She basically went over the same thing. And actually, you can back up 1 slide. There is one thing I want to emphasize, and that is we've all gone through some rough times over the past several months. And one of the things we've done is we've improved on our no contact service available. You can see that's the last bullet point. So, and I'm sure you've all had to make some changes in your businesses as well. So we have that service as well. So for those clients who don't like meeting with me, that's another option for them. Next slide. First, I want to talk about year-end tax planning for individuals. And I'm going to start with traditional IRA contributions. It used to be if you were 70 and a half or older, you could not contribute to a traditional IRA, and that changed under the Secure Act. So if you're 70 and a half or older and working, you can contribute to a traditional IRA in 2020. Also, those contributions might be deductible. The next item is making charitable contributions. If you have the financial ability to do so, it might make sense for you if you're age 70 and a half or older, and you make donations, sizable donations to a charity, you can do it directly from your IRA to the charity. Now you might say, well, why would I want to do that? Why don't I just write the check and deduct it on my tax return? There's a good tax reason to do that. If you do it directly from your IRA to the charity, it does not show up on your tax return as income. It's not taxable income. And by doing that, you're going to have a lower adjusted gross income, and therefore you might itemize deductions, whereas before you took standard deduction. And it also might help you qualify for other tax breaks as well. So if you have the ability to do that, you might want to donate directly from your IRA to a charity. Next slide. On your Arizona tax return, what you can do, even if you are claiming standard deduction, you can still deduct something that normally you'd have to itemize deductions to deduct, and that's charitable contributions, cash charitable contributions. On your Arizona return, you can deduct up to $300 of cash charitable contributions, even if you're claiming standard deduction. So you want to make sure whoever prepares your return, CPA, EA, other tax professional, make sure, number one, you give them those cash contributions you made, even if you're claiming standard deduction, and then make sure they report that. And if you prepare your own return, make sure you enter that, even though you're not itemizing deductions, you'll get a tax break. Also on this slide, you can see maximizing 2020 education credits. What you want to consider doing is by the end of the year, within the next 2 weeks, prepay 2021 college tuition bills. And the reason you might want to do that is you can then take advantage of a tax credit. If the tuition you pay is for classes that are in the first quarter, that is no later than March 31, you can prepay it and qualify for the credit. And if the grandparents pay the tuition for a grandchild, you, the parent, can claim the education credit. Or if you're the grandparent, you can give it to them. The child's parent can claim the education credit, even though the grandparent paid it. Also, if grandparents pay tuition directly to a college, there are no gift tax issues. What do I mean by that? The grandparent can pay any amount to a college, $50,000 at once, $100,000 at once, directly to a college, and the grandparent doesn't have to file a gift tax return. There's no gift tax issues. All right, going to the next slide. Still talking about IRAs. It's a common question we get is, should I choose a traditional IRA or a Roth IRA? For a lot of people, if you're going to have your retirement money sit there maybe for 10 years or more, Roth IRA might be the better IRA. And why is that? Because the money grows tax-free in a Roth IRA. In a traditional IRA, it does not. Because with a traditional IRA, you're getting a tax break up front. But what you want to do also is maybe convert a traditional IRA to a Roth IRA this year. Because of the virus, some of the businesses have less income. Maybe employees were laid off, reduced hours, your income is less. This might be the year, 2020, to do a conversion from traditional IRA to Roth IRA. That way you'll pay less tax when you convert. And it's got to be done by the year end, and it's irrevocable. Now, some people might not qualify to contribute directly to a Roth IRA because of their income. There are income limitations. If your income's over a certain amount, you can't contribute to a Roth. But there's something you can do, and that's called the backdoor policy, the backdoor method, I mean. And what that is, you can contribute, make a non-deductible contribution to a traditional IRA. And then sometime after that, convert it to a Roth IRA. It's perfectly legal, and that's the way you get around it. Lifetime annual gift tax exclusion. One person can give another person $15,000 during a year, and nothing has to be reported. No gift tax return, no gift tax. Person receiving it, it's not taxable, nothing reported. Also keep in mind the lifetime gift tax exclusion for 2020 is $11.5 million, $11,580,000 to be exact. This last bullet is probably the most important one for you to understand. And that is, although there's the $15,000 limit on a gift to exclude in a year, if money is paid directly from someone to a college or university for tuition, there's no limit. They can make that they can pay the tuition directly to the college or private primary education, elementary school, for example, and there's no gift tax and no gift tax return. It's perfectly excludable. Same thing with medical. If there's someone in the family who has high medical bills, someone, maybe a parent, grandparent, can pay those medical bills, but they've got to be paid directly to the healthcare provider. And if they do that, there's no limit on how much they can gift the person indirectly is what's happening. So for those of you whose parents have the financial wherewithal maybe to pay your kids' tuition or medical bills, you can tell them today that you heard from a CPA that, hey, it's a great idea to pay for your kids' education or the medical bills. Next slide. Year-end tax planning for individuals still, managing your stock portfolio. It might make sense if you have some stock mutual funds that show a loss, it might make sense to sell so you can take advantage of the loss this year. You can offset capital gains with losses. Anything you don't use, you carry over. But this last bullet point, most people don't understand, and they find it hard to believe. And that is, if your income is under a certain amount, you pay 0 capital gains. That is, you can sell stocks, mutual funds. You could sell a second home and have a capital gain and maybe pay no tax. And that is, if you're single and your taxable income is under 40,000, you pay 0 tax on capital gains. 80,000 if you're married, 53.6 if you're head of household. So that's something to keep in mind as well. Next slide. Now we're talking year-end tax planning. It was about individuals. Now we're going to talk about small business owners. Next slide.
Sorry, Steve, I'm having some tough, there we go.
All right, thanks. What you want to do if you're a business owner is you want to think about purchasing some things over the next 2 weeks if it makes sense to take the write-off this year. Maybe your income is higher than normal. You can buy computer equipment, you can buy other equipment and write it all off. Under the Tax Cuts and Jobs Act, you can take 100% first year bonus depreciation. What that means is you can deduct it in full. You don't have to depreciate it over 5 years or more than that. You can also, the second part there about net operating loss. Again, it's been a tough year for most businesses and a lot of them are showing a loss. What you can do is you can, if you had a loss, you can choose to carry that loss back 5 years in order to get a refund of taxes paid in those earlier years. Now, something to keep in mind, if you think tax rates are going to go up, you might want to wait and carry that loss forward and have it offset against future taxes when the rates might be higher, but that's an option. If you've got financial difficulties, this is something you can do. Carry loss back, get a refund of taxes you paid. Also, if you're a business owner, last part there, establish retirement plan. If you are self-employed, for example, an LLC, or you're not an LLC, let's say sole proprietor, you do a Schedule C on your personal tax return, you can set up a SEP IRA and contribute up to 20% of the net profit from self-employment that is shown on that Schedule C. Second item there, if you own your own corporation, maybe you have an S corporation or you have an LLC that is taxed as an S corporation. What you can do is up to 25% of the salary that you get out of that corporation can be contributed to a SEP IRA. Now, why would you want to do that? It lowers your taxes. You get a deduction for it, or it's pre-tax. It's not going to show up on your tax return as taxable income. Plus, you're saving for retirement. It's going to grow tax deferred. Maximum amount you can contribute to those type of plans is $57,000 in 2020. You can also set up your own 401k. If you have a Schedule C, for example, you can set up what's called a 401k, solo 401k, and contribute $57,000. Next slide. 6 reasons, totally different topic. Everyone wants to avoid being audited. And here are 6 things to keep in mind. One is about 1% of tax returns, actually a bit less, are chosen at random. There's nothing you can do about that. Number 2, entertainment expenses are no longer deductible. Whereas you used to be able to deduct some of the expense related to sporting events, concert, maybe a customer appreciation party, you can no longer deduct that. But the meals that you purchase while doing those events is still deductible if they're reasonable. Number 3, don't go overboard with your deductions. Some clients, one of the business deductions they take maybe too much is business travel and business mileage. You want to be careful, make sure you have good records. When it comes to business miles, make sure you have a log that supports what your business miles were, where you went, the purpose, so on and so forth. Number 4, you might want to think about incorporating or form an LLC. If you haven't done anything, you just started a business, by default, you're a sole proprietor, you probably prepare a Schedule C. You might want to form an LLC if you're worried about maybe being audited. The reason the IRS, you're less likely to be audited then is because when you incorporate, the IRS thinks it shows some level of organization and financial competence. It may not be true, but that's what they think it does. Whereas when you're a Schedule C, those are more likely to be audited. Number 5, don't use round numbers or numbers same as previous year. This is very common. A lot of clients, they say I drove 20,000 miles. They're estimating 30,000 miles. It's best to not use round numbers. And even if you're going to make an estimate based on a week and multiply that by 50 or 52. So the number isn't so round. But again, you need to have a log. You need to have something to support what you're deducting. In this case, miles. And don't just use same as previous year. Some clients like to say all my numbers were same as last year. You don't want to do that. That is an area that is most likely going to, or I should say, higher probability of being audited. And the last item, filing tax return electronically. According to the IRS, you're more likely to be audited if you file a paper return than if you e-file. And the reason is, on a paper return, 21% of paper returns have errors, and that's according to the IRS. Whereas if you file electronically, 0.5% of tax returns had errors. Now, and it may not be you that made the error if you file a paper return. Keep in mind, if you file a paper return, the IRS receives it and someone there has to enter that information. So they might make the error. So it's another reason to file electronically and not file on paper. Next slide. And again, we're not going to talk about politics here, but we are going to talk about taxes. Whenever there's a major change in the political scene, you can expect some changes in taxes, and that's what keeps us in business. One thing under the Biden administration proposal is raising the top individual tax rate from 39.6% to 37%. That may not sound like a lot to most people, but the next item, they're thinking of raising how much goes into Social Security. Right now, the employee and employer combined pay about 12.4% into Social Security. The Biden administration is thinking of raising that. Right now, it's only the first 137,700 subject to that 12.4%. The Biden administration is thinking of raising that to over 400,000. So if your income is over 400,000, you might see a big increase in taxes. Another reason to take advantage of some of these deductions we've talked about. The second part there, capital gain tax, as you can see a couple examples there. Let's say, for example, a father owns a car dealership and he's thinking of selling it to his daughter for $10 million next year, 2021. He might want to do that transaction in December of this year instead. That guarantees him a 20% capital gain tax rate instead of the nearly 40% next year, which might come about. Same thing if you're a partner in a partnership. You might want to sell this year over the next 2 weeks instead of waiting till next year, because if you do, you might pay more capital gains on the sale. Estate tax. The Biden administration, what they are considering doing is lowering the estate tax exemption to $3.5 million from the current more than $11.5 million. So if you have a sizable estate or you know someone who has a sizable estate, that's something to consider as well. But one way to avoid that is give away money in December this year instead of 2021 to avoid the lower estate tax exemption. Another reason to tell your parents or grandparents to give you money, right? Biden is proposing elimination of at-death step-up and basis of inherited assets. Now, I know that sounds like a boring topic, but trust me, if you inherit some money or you become an executive of an estate, you'll understand this concept and you'll appreciate you heard this today. Right now, for example, someone dies and let's say you inherit their house and the house is worth $300,000 at date of death. Your basis is $300,000. So if you sell it shortly thereafter for $300,000, no taxable gain, no taxes. With the new Biden proposal, if they get rid of the step up, let's say the person bought the house at $100,000 and it's worth $300,000 now. You'd pay tax on that difference, $200,000. That's in general. That's a rough example, but just so you understand the concept there. Next slide. And this is the last concept I want to talk about, and that's the PPP program. I'm not an expert on the PPP program, but I do want to get across to you some very important points. One is, if you received a PPP loan this year, you could be facing a big tax bill. It's important that you understand this. And it's not on the amount you received. The amount you received, if you received a loan, and even if it's forgiven, it's not taxable. But where you get hit tax-wise is whatever you use that money for, those expenses are not deductible, even if they were in the past. So let's say you borrowed $100,000 under the PPP program, $100,000. It's not taxable to you, but if you use that $100,000 for, say, wages, those $100,000 of wages are not deductible. So that, in essence, could mean you have $100,000 more taxable income. So keep that in mind. This is something, just so you know, as a side note, it was not the intention of Congress to do this. Their intention was to make the PPP loan money you receive tax-free and to have you still be able to deduct those expenses. But the IRS is disagreeing. So that could change. But as of right now, you would not be able to deduct expenses if you use PPP money for those expenses. What happens if you don't spend all of your PPP loan money? The money becomes a loan. Early when the PPP program started, you had to use the money within 8 weeks. Then they came out with another PPP loan program. You had 24 weeks. If you don't use the money within the amount of period that was for the loan you took out, you will not have to pay it back, but you'll just have a loan that you have to pay 1% on. It's a low interest rate loan. So it's not a bad thing. It's just something to keep in mind. Last thing I'll mention, very important. It's very important that you track the PPP loan money that you have and how it's spent. It's important that you, first of all, you should have books, financial statements, balance sheet, P&L. You want to have separate accounts where that money was used. For example, you pay wages. Well, now you want to have 2 wages accounts. One is wages. The other one is wages PPP loan. That's the account you use for when you pay wages with PPP loan money. Why do you want to do that? If you're going to ask to have it forgiven, they're going to want that separated. It's going to make it easier for you if you do that up front. And the last slide, I know I went through this information pretty quick and didn't go too deep, but if I hit on any topics that apply to you and you have questions, you've got my information there. You can send me an email or you can give me a call. And thank you very much. Back to you, Carly.
Awesome. Thank you so much, Steve. Appreciate that information. I'm sure that many of us, our heads are spinning. It was a lot of numbers and a lot of information. And I'll be sure to send out the recording with the slide deck as well. That way, if there's anything that anyone wanted to reference, you'll be able to see that again. If anyone does have any questions for Steve, please feel free to post those in the chat right now. I do see that we had one question come in. Are there any new tax deductions for contract workers this year?
New deductions. Wow. I wouldn't say new ones. I'd say the direction the IRS has been going is taking away entertainment expenses. But as far as new deductions, no, it's pretty much the same as what it's been. I'll say this though. Last year, as I mentioned, some new ones came out, like the bonus depreciation, 100%. Without boring you with the detail with all that, bottom line is if you buy some equipment for your business, including a vehicle, you might be able to write it off all at once instead of depreciating. So that's something somewhat new.
Awesome. Thank you. All right. Well, thank you, Stephen. We appreciate you joining us. And I'm going to turn it over now for a quick update from Paula Whittakin with SBDC. Paula, are you on?
I am.
Awesome.
All right. Let me go ahead and share my screen. All right. Carly, do you see the screen?
I do.
Yes.
Okay. All right. Perfect. All right. Let me just go into presentation mode here. Well, welcome everyone. We're finally at December. It's hard to believe that we're the last month of the year, just before the holidays. I just wanted to quickly overview for you again, if you're not familiar with the Small Business Development Services and how we're helping our clients at this time. So the SBDC, we are part of a national network actually of business counselors, and the Maricopa SBDC is part of the Arizona network. And what we offer is no-fee counseling to small businesses in any industry, anywhere in that life cycle stage, from I have an idea and I'm not quite sure where to take it from here, all the way to those who are very established small business owners. We provide no-fee counseling, training, and we have some access to some great resources at no cost to our clients. And you see, and we're able to offer no-fee counseling. There's no trick to this. We are funded by Maricopa Community Colleges and also by the Small Business Administration at the federal level. And we do have a partnership with the Arizona Commerce Authority. And that is how we are able to provide this no-fee counseling to our clients. And we've had clients that have been with us for many, many years and no fee for any of those services. And you see listed here just some of the areas. Steve talked briefly about the PPP loans, but we've been helping our clients kind of navigate the disaster loans, the EIDL loans, the PPP loans. You know, we're getting a lot of questions now about the forgiveness process and what that looks like. So if you need help in that area, we are here to help you, and we'll see what Congress does as we get to the new year. But if you need some assistance, we're here to help. We also help our clients. You know, a lot of our businesses now are looking for additional funding. We help you kind of get lender ready and scope out lenders that might be a good fit for your industry, the amount you need, and how you're going to use those funds. But we also help with financial review, looking at some resiliency assessment, marketing assessment, planning, sales. You know, if you're looking to buy a business, sell a business, we can provide some guidance there. We have an expert in manufacturing, technology commercialization, export and international trade, and also government contracting. So we do have about 17 counselors across Maricopa County. We're all working virtually. And the benefit of working with us really is you might get a lead counselor, but all of us have expertise in different areas. So you actually get the expertise of all of that Maricopa SBDC team. And just a note, since Steve is on the line here as a CPA, we don't offer, we're not CPAs and we're not attorneys. So oftentimes, you know, when we get into these deeper areas of knowledge for, you know, tax planning, we like to refer to our CPAs and our attorneys for guidance. But we have some tools that can really help you with some foundational items that you can take to your CPA and work with them on. So just very briefly here on some of the resources we have. We do license a tool called Growth Wheel, and I know it's very small, you can't see it there, but it's really a platform that covers all areas of business development, some self-paced tools to guide our clients in using counseling. We do now have access to Live Plan, so if you are looking to develop a business plan, this platform is free to our clients. And so that's a great tool, especially at this time of year. It's important that everyone is planning ahead. And that includes financial forecasting in there as well. We have access to ProfitSense, our financial benchmarking data, where we can run reports based on your industry, your NAICS code, so that you can see how you compare to other businesses in your industry. We use this in counseling, but you know, this is a great tool too to kind of take to your CPA or your bookkeeper, whoever you're working with financially. So that's a great tool for you to know that we have and to use in your business. We also have access to IBIS Industry World Reports, and we have our SBDC Net, which is our marketing organization that can run some specific marketing reports for you based on your needs. So just a snapshot view of all the different resources we have available to clients. And just to close it out today, I wanted to just share a couple of New Year's resolutions for you to consider. Just some bigger goals for the business. Think about, you know, what is your business legacy? What is it that you're looking to leave, you know, for customers, your community, your culture? How are you going to strengthen your relationships? Kind of think about, you know, your customers, of course, especially as we're all working virtually now most of the time. You know, what are you doing to strengthen those relationships? What about with your employees and even your vendors, your suppliers? You know, obviously doing this has some real tangible benefits, but also some intangible benefits. So think about how you're going to strengthen those relationships. And, you know, I was a business owner for 15 years myself, and, you know, just it's very busy from day to day, but really think about what are you going to do to develop your own small business leadership skills as we head into 2021. It's really important to carve out some time on your calendar to do that. And then how are you going to build your support system? Surround yourself with resources like the Chamber, the SBDC, your fellow business owners in the community. Really build your support system, and don't be afraid to ask for help, because we're all navigating this and trying to help each other through this as we get into 2021. So just some thoughts for you to consider about those New Year's resolutions for your business. If you are interested in SBDC counseling, it's very easy. Just go to our page. I've got it listed there. Fill out a request for counseling form. That puts you into the system, and you're assigned a lead counselor who can sit down and just have that initial conversation, learn about who you are as the business, what are your goals going forward, what are your challenges, and we can look to see how can the SBDC kind of fill some gaps that maybe some of your other resources in your network can't provide, and how it complements those resources that you already have. So we'd love to have an initial session with you. So please feel free to reach out, whether before the end of the year or as we head into 2021. And this is my contact information. If you would like to reach out to me, just send me an email and we can have a conversation to talk about SBDC and how we can help you out. So thank you again, Carly, for your support and the support of the Chamber. And happy holidays to everyone. So
thank you, Paula. Well, thank you both, Stephen and Paula, for sharing such valuable information with us. We know that it's been truly a unique year with some unprecedented circumstances, and we continue to want to provide access to community and information, even in a virtual format. So we're so grateful that you took the time. And thank you also to everyone for tuning in this morning to connect and educate yourself on some great resources as the year wraps up. Thank you to the City of Chandler for the Industrial Development Authority for the support that they give so that we can continue to put on programs like this. I will be sending out that recording, the recording of this session as well as both slide decks from Paula and from Stephen. So if there was anything that really caught your eye, and their contact information will be included. So please do not hesitate to reach out. We thank you guys for the accessibility that you provide to all of our members and the insight that you offer. We will be hosting our last Strategy for Success webinar of the year next week on December 17th. Mark Stewart and Jillian Grimmer are going to be back with us from Concept to Completion, and they're going to host a session on reimagining your vision and mission for 2021 in light of the current circumstances. So please feel free to register on our Chamber website, and we will see you all next week. Thank you.
Bye all.
bye.